All right, let's talk about investment banks. You've definitely heard the term, probably in a movie with a bunch of people yelling on Wall Street, right? But what do these places actually do? Well, in this explainer, we're going to pull back the curtain and break it all down.
Yeah, I know. It's a world that can seem super complex from the outside. But trust me, once you get the hang of a few core ideas, it all starts to click. So, to start, let's actually talk about what an investment bank isn't.
Okay, first things first. Let's clear up a really common mix-up. The bank you go to for your checking account or maybe a car loan, that's a commercial bank. They serve you and me, the general public. Investment banks, they're a whole different animal. Their clients aren't everyday people. We're talking massive corporations, entire governments, and huge investment funds. And that brings us to Section 1, Not Your Average Bank. The subtitle here is key, Defining the Financial World's Intermediaries. Because really, if you want to understand what an investment bank does, you've got to think of them as the ultimate financial matchmakers. So what does intermediary even mean in this context? Let's make it super simple. Imagine a giant tech company needs, say, $1 billion to build a new factory. And over here, you've got a massive pension fund with $1 billion that it needs to invest to grow. The investment bank is the go-between. They're the ones who structure the whole deal, connecting the company that needs the money with the investors who have the money. Simple as that. Okay, so how do they actually pull this off? Well, to get that, we need to pop the hood and look inside the machine. You'll find that most investment banks are built around 4 main divisions. Think of them as 4 core engines, each one doing a very specific, very important job. Let's kick things off with engine number 1, the investment banking division, or IBD for short. Honestly, this is probably what you're picturing when you think of investment banking. It's that classic, high-powered advisory part of the bank. So what's the IBD's day-to-day? Well, you know when you read in the news that one giant company is buying another one? That's a merger or acquisition, M&A for short, and the IBD are the folks advising on that massive deal. Or what about when a company, like a hot new startup, decides to go public and sell shares for the first time? That's an IPO. And yep, the IBD manages that whole crazy process. They're basically the architects behind the biggest deals in the business world. And this really breaks down their business model. Look at the clients, corporations, governments, and these things called private equity firms, which are basically companies that specialize in buying and turning around other companies. So how do they get paid? It's all about fees. They get a slice, a percentage, of every single deal they help put together. All right, on to engine number 2, sales and trading, or S&T. Now, if the IBD is all about long-term strategic advice, S&T is the complete opposite. This is the bank's live connection to the markets, the beating heart. It's that fast-paced, high-octane trading floor you always see in the movies, with screens flashing everywhere. The main gig for the S&T division is to be a market maker. What's that? It just means they're always ready to buy or sell stuff, stocks, bonds, you name it. That provides liquidity, which is just a fancy word for making sure the market runs smoothly, so it's always easy for other people to trade without prices going haywire. They do this for their clients, and sometimes they trade the bank's own money to try and make a profit. That's called proprietary trading, or prop trading. So you might be wondering, how do they make money on all this buying and selling? Well, a huge part of it comes down to something called the bid-ask spread. It's pretty simple, actually. The bank has 2 prices for everything it trades. A price they're willing to buy at, that's the bid, and a slightly higher price they're willing to sell at, the ask. That tiny little difference between the two, that's their profit on each trade. Now multiply that tiny profit by millions and millions of trades a day, and suddenly it's a massive river of cash. So yeah, you can see their money comes from a few different places. Their clients are the big fish, institutional investors like pension funds and hedge funds. You know, those investment funds that play with really complex strategies. The bank makes money from commissions on their trades, from that bid-ask spread we just talked about, and of course from their own prop trading. Okay, let's move on to engine number 3, the research division. If S&T is the heart of the bank, then research is definitely the brain. Now, here's the key thing to understand about research. It's not a direct profit maker. It's a support division. Its entire job is to arm the other engines with intelligence. The analysts here are digging deep, producing these super detailed reports on companies, economies, and whole industries. That info is absolutely vital for the IBD guys to figure out what a company is worth, and for the S&T folks to give smart advice to their clients. And that brings us to our 4th and final engine, asset management.
This division has a very clear and straightforward job: manage other people's money, and lots of it.
The clients here are, again, big institutions, but also super wealthy individuals. The bank basically takes their pile of cash and invests it for them, using all sorts of different strategies, all with the goal of making that pile of cash even bigger over time. And how do they get paid? They charge a management fee, which is usually a small percentage of the total amount of money they're managing, what's known as assets under management, or AUM. All right, so now we know what's going on inside a bank, but not all investment banks are the same. Let's get into the different types. They're generally broken down into three main categories: bulge, middle, and boutique. So this table lays it out pretty clearly. At the very top, you have the bulge bracket banks. Think Goldman Sachs, JP Morgan. These are the global heavyweights handling the absolute biggest, most complex deals in the world. Then you've got middle market banks. They focus on serving, you guessed it, mid-sized companies. And finally, you have boutique banks. These are smaller, often highly specialized firms. They might only do mergers for tech companies, for example, but they're the best in the world at that one thing. Okay, so we've looked at the engines, we've looked at the different types of banks. Let's pull back for our final section here and ask the big question. Why does any of this matter? Why are these financial architects so important to the global economy? When you get right down to it, investment banks are like the essential plumbing of our economy. They're the ones who channel capital from investors to companies, allowing those companies to build, to innovate, and to hire people. And by advising on these massive deals that can reshape entire industries, they really are shaping the structure of our whole economy. And that leaves us with one final and pretty important question. We've called them the architects of our economy. But what happens when the blueprints are flawed? It's a powerful thought, and it really gets to the heart of the incredible influence and the immense responsibility that these institutions have in our world.